Hey everyone, welcome back to Corporate Decoder, the place where we decode the world of business and finance one filing at a time. Today we're diving deep into INVO Fertility Incorporated's latest quarterly report, and let me tell you, it's a roller coaster of numbers and corporate maneuvers. Before we dive in, if you're looking for clear, no nonsense insights into company financials, make sure you hit that subscribe button. And for more exclusive discussions and to connect with our community, join our Discord server linked in the description below. So, INVO Fertility, a company focused on making fertility treatments more accessible. Sounds like a noble mission, right? Well, their recent report paints a picture of a company in transition facing challenges, but also making strategic moves. We've got a lot to unpack, from revenue shifts to significant financial events. Let's get right into it. First up, let's look at the company's financial health as shown on their balance sheet. As of the 30th of September 2025, the company had about $355,000 in cash, which is a notable decrease from over $600,000 at the end of the previous year. Their total assets also saw a massive drop from over $46 million at the end of 2024 to just under $19 million in September 2025. This big change is largely due to assets that were held for sale being moved off the books, especially a significant chunk that was over $32 million at the end of 2024. This tells us they are actively shedding parts of their business to streamline operations. Liabilities also decreased, mainly from selling off those assets, which is a good sign that they are reducing their overall obligations. Now, let's talk about how the company is actually performing in terms of making money. For the 3 months ending the 30th of September 2025, their total revenue was around $1.7 million, a nice increase from about $1.4 million in the same period last year. That's about a 23% jump, showing their core fertility operations are actually growing. However, their operating expenses also shot up from $2.7 million to over $3.3 million. This means that even though they're making more money, they're spending substantially more to do it. The result is a bigger loss from operations, about $1.6 million this quarter compared to $1.3 million last year. Looking at the 9-month period, revenue also increased from about $4.8 million in 2024 to $5.2 million in 2025. That is about an 8% increase, which is solid but not as dramatic as the quarterly jump. But here is where it gets interesting. For the 9-month period, their total operating expenses ballooned from $9.5 million to over $11 million. This surge in spending, combined with a significant charge for impairment loss, a whopping $1.3 million this year, even though it was zero last year, alongside a loss from debt extinguishment of $1.5 million this year, turned their operational losses into a much larger number. They went from a loss of $4.6 million to over $5.8 million, and the bottom line figures are even more stark. For the 9 months ending the 30th of September 2025, the company reported a net loss of over $25 million. This is a massive jump from a net loss of about $5.4 million in the same period last year. A big chunk of this difference comes from the divestiture of their Naya Therapeutics segment, which resulted in a loss of over $16 million from discontinued operations, on top of their ongoing business losses. This really underscores their strategic shift back to focusing solely on fertility. Let's check the equity side of things. The number of common shares outstanding has significantly increased, which is common when companies raise capital through stock offerings. As of the 30th of September 2025, they had over 5.4 million shares outstanding compared to just over 124,000 at the end of 2024. This massive increase is due to a combination of stock issuances, including for cash debt conversions and warrant exercises. It is a clear sign they've been actively raising money, which is crucial given their cash burn. However, their accumulated deficit, which is essentially the total net losses over time, has widened significantly to over $93 million. This highlights the long road they have in front of them to achieve profitability. Now, let's talk cash, because that's where the rubber meets the road. For the 9 months ending the 30th of September 2025, the company used about $7 million in operating activities, a huge leap from the $2.3 million used in the same period the previous year. This isn't surprising given the rising expenses we discussed. Investing activities used a relatively small amount, around $38,000 this year compared to about $29,000 last year, mostly for equipment purchases. But here is where the financing section really tells a story. In the first 9 months of 2025, they brought in about $6.7 million from financing activities. This inflow was mainly from selling preferred stock. exercising warrants, and a significant public offering. However, they also used a good chunk of this money to redeem preferred stock and repay debt. It looks like they are constantly juggling bringing in new money while trying to clean up their balance sheet. For context, last year they brought in about $2.6 million from financing. Diving into the notes reveals some key details about their strategy and operations. One major event was the acquisition of INVO Therapeutics Incorporated in October 2024. This was a move to diversify beyond just fertility. However, it looks like the strategy shifted, and in May 2025, they divested a majority stake in INVO Therapeutics, showing a clear return to focusing solely on the fertility market. This divestiture resulted in a significant loss on disposal, but it streamlines their business. They are also actively managing their debt. We see various notes payable, including related party demand notes, convertible notes, and a convertible debenture. The company has been using a mix of debt and equity to fund its operations. Some of these notes have high interest rates, and some have clauses that allow for conversion into stock, which can dilute existing shareholders. The company has also been diligent in amending and restructuring its debt, trying to manage its obligations effectively. The company is involved with several variable interest entities, or VIEs, which are essentially entities where they have significant influence or control. They've consolidated one VIE, INVO LLC, and used the equity method for another, HRCFG INVO LLC. These VIEs are part of their strategy to expand their fertility clinic footprint. They purchase invoicals from the company for these VIEs, which is a source of revenue for INVO Fertility. This shows a vertical integration strategy where their own product is used in their affiliated clinics. Looking at how the company breaks down its business for reporting purposes gives us more clarity. They operate in three main segments: fertility clinic services, invoical device, and therapeutics. For the 9 months ending the 30th of September 2025, fertility clinic services generated over $5.1 million in revenue from external customers, while the invoical device brought in over $82,000. The therapeutics segment, as expected, had no revenue due to the divestiture. Critically, they incurred significant losses within the therapeutic segment due to impairment charges. There have been some significant corporate actions recently. In July 2025, they increased their authorized common stock significantly from about 1.3 million shares to 50 million shares. This gives them a lot more room to issue stock for future fundraising or acquisitions. They also executed 2 reverse stock splits, one in March 2025 at a 1 for -12 ratio, and another in July 2025 at a 1 for -3 ratio. These moves are often done to increase the stock price per S-hair, making it more attractive to investors, especially after a period of falling stock prices. The INVO Therapeutics divestiture in June 2025 was a major step, and they received a significant amount of money back from selling a majority stake. The company also raised substantial capital through a public offering in January 2025, bringing in over $8.7 million in net proceeds. A good portion of this money was earmarked for strategic uses like redeeming preferred stock and paying down debt, which is a positive sign of financial discipline. So, what is the story here? INVO Fertility is in a clear pivot. They divested their experimental therapeutics business to double down on their core fertility offerings. This move, while resulting in a large net loss for the period due to one-time charges from the divestiture, should allow them to concentrate resources and efforts where they see the most growth potential. Their fertility services revenue is growing, albeit steadily, and their strategy to acquire profitable IVF clinics alongside building their own INVO centers seems sound. However, the company's heavy reliance on debt and equity financing to cover significant operating losses and fund expansion is a considerable risk. The widening accumulated deficit and the substantial cash burn from operations are red flags that investors will be watching very closely. The reverse stock splits and the increase in authorized shares suggest they are preparing for further capital raises or stock-based compensation, a double-edged sword that can fuel growth but also dilute existing shareholders. In conclusion, INVO Fertility is making bold moves to reshape its future, betting big on the fertility market. While the recent results are heavily impacted by strategic shifts and one-time charges, the underlying growth in their core business is encouraging. The key challenge will be managing their cash runway and achieving profitability before they exhaust their funding options. It's a high-stakes game in a growing market, and their success will depend on their ability to execute their clinic acquisition strategy effectively and control costs. That's our deep dive into INVO Fertility's latest quarterly report. What are your thoughts on their pivot back to fertility? Do you see this strategy leading to profitability or more challenges ahead? Let us know your take in the comments below. If you found this analysis helpful, please give this video a thumbs up and subscribe for more in-depth looks at company filings. And don't forget to join our Discord community for more discussions. Thanks for watching, and we'll see you in the next one.